Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Charlotte, we're glad to have you on Swimming with Allocators. Thanks for joining us.
Of course. No, I've been really excited to have this opportunity to have the conversation with you all. Have been a fan and listening to some of your episodes. So thanks for having me.
When starting this podcast, almost, I guess, a little over 2 years ago, one person that I've always thought about having on was Charlotte. We've known each other. I don't even know how long we've known each other now, but we have a mutual friend, and I've always appreciated your thoughtfulness and insights and just how much of a badass you are. I appreciate you.
Oh, thank you. I've always appreciated that we have really deep conversations that feel real, where we're trying to peel back the layers on different dynamics and topics. So I appreciate you've always been a really good thought partner.
Thank you. Well, so the audience can understand why you're such a badass. Could you just walk us through how you got to this point, jumping into this weird world of allocating?
Sure thing. So I like to joke that I don't think anyone grows up dreaming of becoming an allocator when they're a kid. There's just way too much, I think, obfuscation about what this role actually entails. And it's certainly not something you're going to see in the media, right? Mm-hmm. So how I eventually wound up here was, it was actually happenstance. So I had done technology investment banking as my first role out of college, and a colleague that I had worked with there had gone on to work for Medley Partners, which is Jim Simon's private markets arm, and asked me, so what are you thinking about doing and going to the buy side? And I said, well, probably, some technology growth equity strategy, given those tend to be the client organizations that I've worked with on the transactions at the investment bank. And he asked a really good question. He was like, okay, so, but how do you know, right, the difference or differentiation and edge between someone like a Summit or an IVP or a Meritech? And I said, oh, well, I suppose, you get a sense of like the people that you've had interactions with. You look at the company's website and see kind of the types of companies that they're interested in investing in. And he said, well, but if you're going to commit your career to doing this, wouldn't you want to know? Wouldn't you want to know exactly how good they are in terms of, their track record of returns, how they actually think about competitive positioning? And, if you were to sit on the LP side at an organization like ours, you could actually have full agenda.
Yeah, it sounds like a perfected pitch.
So needless to say, his logic was extremely credible. And so I said to myself, okay, well, why don't I give it a try? And so I joined them, but, long story short, it's been well over a decade and still here on the allocator side.
I freaking love that advice because I'm sure this happens to you too as well, that people are interested in your opinion about joining a startup. Perhaps they haven't been in the startup world before and they're sort of saying, what do you think about this particular firm or this particular company? And you sort of say, well, you're investing your life as opposed to capital, and you kind of help them look at it the way you would look at it. And I think hopefully people on this show are also starting to think a little more critically about who they would want to start a fund with or what fund they would want to join because they're starting to have that allocator perspective. So, Charlotte, I feel like you were ahead of the curve. Did you ever want to go back? I mean, there was supposed to be a stop on the train.
It was. So I would say that I didn't appreciate how much I would enjoy the allocator seat because it's truly, you have such a wide variety of learning opportunities day to day, right? Especially since here at Inatai, we're structured as a generalist program. And so, one day I could be spending time looking at Brazilian long only strategies. And then the next day I'm looking at, seed stage venture strategies in the US focused on AI. And perhaps the day after that, it's European real estate. That sort of mental stimulation you get from having broad exposure to a wide variety of ideas, I think is something that really works for me and keeps me excited. However, I think, right, what would make an exceptional GP investor is that obsession to go really deep, a mile deep, right, and an inch wide on something. And I also have appreciation for that commitment as well. But it's a trade-off, if you will.
Since you brought it up, could you provide, more information on, how Inatai started and its focus areas and who it's looking to serve?
Of course. Yes. So Inatai is a 501c4 philanthropy that is seeking to really transform the balance of power to ensure equity and racial justice across Washington state. So in 2021, we actually formed Inatai Investment Management Company that then invests and manages capital on behalf of the foundation as well as other aligned organizations. So the goal, right, is to generate long-term sustainable returns while also advancing racial justice and equity work. So we try to think of our goal as prioritizing people over profit and making investment decisions that are based not just on the potential to make outsized returns, but also, right, the potential to improve the lives of the people and communities that we and our partners serve. I think that's probably a key distinction in terms of how we choose to invest.
There's a clear focus on the organizations who they're looking to serve and the benefactors of the foundation. When developing kind of or executing on this investment strategy, are there any kind of constraints or kind of guiding principles that limit or expand where you can invest in fund managers? Or is it kind of like things are all free, fair game?
Sure. Yes. So I would say that in general, you can think of our investment strategy as following the endowment model.
Okay.
Right. So we have a 50-year vision that ensures we're trying to invest according to a long-term time horizon, have diversified portfolio that includes alternative assets, and then our approach is trying to be rooted in a commitment to long-term sustainability, strategic diversification, and then a dedication to our organizational values and mission. When you look at our investment theses, they tend to focus on inefficiency, innovation, and impact. We like talking about acronyms, so those are your 3 I's. So in inefficient markets, right, allows us to purchase assets at hopefully below intrinsic value. So for example, we'll invest in early stage venture and emerging markets. Investing behind innovation allows us to participate at the right point along a growth curve. So we'll invest in industries that have significant growth potential, right? Like technology, life sciences. And then finally, we believe that investments that have a positive impact just have a longer duration. So perhaps one way in which we differ from other institutional investors is that we don't have asset class buckets or restricting kind of investment styles to these predefined boxes. We recognize that asset classes, investment strategies, styles, regions, sectors, all of these things, they exist on a continuum spectrum of risk and return. So the critical factor is actually trying to determine your institutional risk tolerance, so both your ability and then willingness to take risk. And then from there, determining kind of the overall surface area you can allocate to that still ensures the risk to the portfolio aligns with or falls below the inherent risk of the standard policy portfolio, which for us is a 70% allocation to equities and a 30% allocation to bonds. So as a result, if we just aggregate all of the equity beta of all of our funds, right, that total number should be around 0.7 or less. So in terms of guidelines, I'd say that that is one of our broad guidelines that we adhere to.
It's an interesting story arc that you are now also managing other foundations' capital. What's that experience been like, and has that changed your operations or your approach?
I would say that, it's been expansive in the sense that when we seek to partner with GPs, a lot of the times we try and select for GPs that actually resonate with this idea of you select partners in concert with the legacy and impact that you want to generate with your returns, right? And that inherently actually serves as a sense of motivation for why your team will push even harder to generate best-in-class returns. So I'd say, of course, we have an amazing mission that we serve, but in bringing along additional capital partners, it just diversifies even more great causes on behalf of which the GPs are able to fund through the returns that they generate. From an operational perspective, we actually haven't added any headcount with regards to expanding our capabilities there. As an OCIO, we are able to have full discretion, and so what we are invested in is also what our capital partners are invested in.
One question I did have was around, you're jumping in so many different asset classes. We have a lot of younger folks who are just jumping into being allocators, or people who are making career switches into being an allocator. If you have a multi-asset class strategy, how do you take in all the information and use it to your best ability when you're jumping around and not feel inundated with so much and feel like you can't do anything?
Of course. So I would say that, when it comes to organizing our workflows, right, there are a couple of key elements of the process that help us keep organized and prioritize as to what we are focused on in any given year. So one, of course, we have a forward calendar that highlights from a bottoms-up perspective, right, those managers that are existing re-ups that we'll need to evaluate, as well as the target wish list folks that we've been spending time with and we'll need to make a decision on as well. So that's from a bottoms-up perspective. From a top-down perspective then, and this is where kind of being generalist really improves our ability to dive deep and learn about different interesting market opportunities. We tend to take thematic research sprints, right? So any given year, we pick areas that seem, again, tying back to the 3 I's, right? Where there's either massive inefficiencies that could be exploited or tremendous growth to participate in. And we'll pick, so for example, in the past, I've spent, time assessing the market opportunity in Southeast Asia or crypto and blockchain technologies. And most recently, I've actually been looking at Latin America. But the idea is that asset classes, right, are simply a vehicle by which you can own underlying exposure to a certain type of company. But you should decide, right, what type of company it is that you fundamentally want the access to. And so that's why the asset class, it doesn't need to be organized by asset class, right? Like, for example, I'll give even a different example, which is, for example, if you were to spend time in an area like biotech, right? You could think of it as, so from the 3 I's perspective, right? There are, of course, massive inefficiencies to exploit because it takes billions of dollars and less than 1% success rate in terms of going from preclinical to a fully commercialized drug, and of course addressing, right, the growth and unmet medical needs of large populations. So this is probably an interesting area to invest in. Once you spend some additional time, you learn, okay, well, in terms of the value capture, right, it seems like, if you had to choose between a single asset versus a platform asset, a platform asset tends to accrete a larger amount of enterprise value over time, right? Because it doesn't generate just one drug, there's opportunities for multiple shots on goal. Okay, so if you're going to target platform assets, then how would you do so, right? At what stage? And we've actually spent a ton of time on this and found that, for example, historically I had backed some early stage incubation venture funds to create these platforms from scratch. Mm-hmm. However, I noticed that the nature of the fund life of a private markets fund is that usually it takes about 10 years, which is the end of the fund life, for the company to go public. Mm-hmm. But at that point, right, they actually haven't proven kind of that they are a full-on platform, because perhaps only the leading asset has achieved a point of clinical, sufficient clinical proof points. And so they're still valued as though they are a single asset company.
We've also heard you talk about 4 Ps. Do you mind sharing with us, is there a P you think is overlooked? This is people, philosophy, process, and performance.
Of course. So if you think about the 4 Ps, the truth is, at the end of the day, they actually all technically come from one, and probably not surprising. It's the P of people. Yeah. So, right, you're trying to pick the people who have developed the nuanced investment philosophy that captures some sort of underappreciated market opportunity, and then have thoughtfully constructed a process that they can then consistently execute upon to generate the outperformance. I find that in terms of the people element of GPs, right, probably high integrity and learning agility are the most highly correlated with sustained success. And I think that's because they tend to build firm cultures that value dissenting opinions and avoiding groupthink, while also embracing humility in the sense of admitting to and then refining their approach from past mistakes. The integrity part is also so important because I feel like it serves as a magnet to attract density of high caliber talent to partner with, whether that's founders, operators in the ecosystem, or LPs.
Now we're going to take a quick break to speak with our sponsor.
Thank you, Mike. Thank you. The Sidley Emerging Companies lawyers seem to be suddenly very busy. What has been keeping you busy lately?
Well, I would say obviously the answer is AI, but it's a little deeper than that, which is, I would say that the level of growth and sophistication of startups from just day one to during the first year has become so much more complex than, even 5 years ago. And so we are being sought out by a lot of different startups at different stages that are realizing, hey, we need really high level, sophisticated advice from day one. We're thinking of, selling GPUs to China. We're thinking of expanding operations across the US and navigating privacy laws across various jurisdictions. We're thinking of raising money not just from VCs in Silicon Valley, but from VCs in Europe, from VCs in Israel. How does all of that work out? A lot of sophisticated questions. So they're realizing, hey, we need somebody that knows the entire global landscape, not just a local firm that can help get me incorporated, which frankly, has been, thanks to AI as well, democratized to a point where that's not the competitive advantage. So we're busy because of the expertise that we offer. We're also busy because a lot of things are happening in AI, thank God, for now at least. And we're also busy because we're getting a lot of exciting repeat work because people are seeing that they can come back to us and get a similar quality of work, but also similar quality of expertise, which they can't get elsewhere.
Yeah. As VCs, we obviously have a huge preference for working with repeat founders. Are you finding that those are the repeat founders are the ones that are sort of coming out bigger and with more complicated requirements out the gates? This is like they see an opportunity.
Yeah, this is, it's funny you mentioned that. I often have this conversation with my new clients where I say, listen, since you're a first-time founder, this is what you should focus on. But I can also tell you the kind of questions I get from second, third, four-time founders because they're different questions. And they usually focus on, hey, I had a successful company, I had an exit, and in retrospect, I wish that I maximized minimized my taxes or maximized how I plan around taxes. I wish that I maximized my ownership or control of the company vis-a-vis investors. I wish that I planned better for an exit and thought about what that means for me, my employees, how to motivate people, and so on. There is definitely value in having seen this journey many, many times and being able to advise founders on where they can optimize and do better. But there's also, in my opinion, value in knowing how that can go over with the VCs and the investors and the GPs and what you should be focused on as a first time, second time, or a fifth time founder, and how much leverage you have in those conversations.
Yeah. No, that makes a lot of sense. What is one thing to keep in mind for tax consideration or tax optimization?
I would say these days it's QSBS. That's what everyone's focused on. Very different than if you asked me this 5 years ago or 10 years ago. A few accounting firms have now created designated QSBS focused groups that help our founder clients and our GP clients, maximize their QSBS. There's various ways to do that. There's ways to structure your investment through various funds. There's ways to think about it. The rules were very recently amended through the big beautiful bill to make access to QSBS benefits easier. But that's something you cannot reverse engineer. So it's something you have to plan for in advance. That's the main focus now of most founders and investors. And we on the Sidley side are very focused on that as well. So not only are all of our ECVC lawyers like me trained on this, but we also have a group of expert tax lawyers that we bring in as early as incorporation to talk about that as early as the first kind of seed rounds, talk through that with investors.
No, that's a great example of how it helps to have such a large team at Sidley that you've got those experts.
And now back to our LP interview.
Speaking of the P of people, I was talking recently to a friend who's an emerging manager, and they spoke about kind of the nuances and difficulties with connecting with foundations and OCIOs. And so I had a question from your view. What is it that fund managers might get wrong about how to interact with an organization like yours?
Of course. And I'd like to say that we're actually quite easy to interact with once you understand the rules of engagement.
Focusing specifically on venture managers, are there any just quick and easy qualifiers? Like, we are looking for X track record, or we are not interested in generalists, or, things that help people know whether they should try to be banging down your door or look elsewhere.
Well, hustle and eagerness is definitely a factor that I think makes for successful VCs. So would not be too turned off by having someone bang down our door, I suppose.
Okay.
I think so as it pertains to our particular observations and perhaps biases. I'd say that we probably have more of a bias towards liking some form of specialization, right? Just because if you think about, especially here in the US, how competitive the landscape of venture capital is, the ability to actually earn your place on a cap table, and for you to occupy mind share with the best, most compelling founders that have options, right? I think it means you have to exceed expectations on some capability. And so specialization could be, it could be specialization with regards to geography, right? You know how to navigate the local markets, an ecosystem in a more efficient way. You have much more inbuilt context as to who's truly exceptional, where are the hotbeds of talent, and how to perhaps communicate with them in a way that really resonates with the types of businesses that they're interested in building. It could be from a sector perspective, right? You simply are studying the emerging trends and therefore have a nuanced perspective as to what makes for a more compelling solution as opposed to one that may have been tried recently or even a decade ago and still won't work today. And then finally, perhaps like value add, right? So one particular thesis I've spent a lot of time on is when you talk to any founders and ask them, oh, like, what are your top 3 most reoccurring problems you're constantly trying to solve? And one of them is always, oh, I need to hire better engineers.
Yes.
All the time, every day. And so, I think that if there is a venture strategy that is able to provide meaningful sort of talent placement, that could certainly be a fulcrum for getting exceptional access to founders. Because this is addressing, right, what they articulate as their biggest need. So yes, those would be some of the attributes I guess I could highlight in terms of how would you differentiate. I would also say that a lot of venture has to do with your network centrality and ability to be that first call, right? Because the earlier that you can invest, obviously, the lower your cost basis, the higher the chance that this actually turns into a power law outcome that drives your fund returns. So having an emphasis and just focusing on the early stage is definitely also something that we really value.
This concept of differentiation has always come up in our interviews, as well as something as a GP building in public I constantly think about as well. And a lot of times it is put on the fund manager, as it should, right? It's their firm, all those things. But in conversations, I've also seen interesting ways allocators have been able to uncover differentiation through questions or diligence, because something happens where, like, a lot of investors, especially great investors, do different things really well. But once it gets through the pitch of the deck consulting firm, or like all the things they've heard from their other fellow VCs, all the pitches start to have this sameness. So I've tried to ask, like, LPs, like, what are ways in which you've been able to uncover real differentiation, whether it be specific questions or ways you do diligence?
Mm-hmm. Yes, no, that's a great question. Well, there are probably corollaries in the way in which you spend time with a company that we spend time with you all, right? And so I think it starts off as, so you're trying to find a venture strategy that's inherently a product serving an unmet need today, right? So the question then that I end up spending a lot of time on is, it's essentially around how well do they understand the market, right? Where are the gaps? Why do these gaps exist? Why will they persist? And then how have they built their strategy in particular to service the gaps in a way that will be sustainable, and have sort of, I guess, proof points of positive results, right? So one of my pet peeves is when I ask a GP, oh, okay, so give me a sense of, who do you tend to compete with? What other strategies may look similar on the surface? But if they do, how are you different, right? And And when a GP says to me, oh, it's just it's a blank canvas out there. It's just me, and then everyone else is over here. To me, that signals two things. It's either, one, you haven't obsessively studied this competitive landscape to know exactly who you're up against, which, right, naivete is not going to prepare you for the true competition. Or two, you actually don't have the confidence to tell me who's rather similar to you, because you might not think that I'll pick you over them.
There are so many things similar about them to many of the other investors out there that it can be hard to figure out your differentiation. But what is the strategy that you are uniquely serving is really helpful.
Yeah, that's why like you have to talk to other people that are maybe outside of what you do, so they can say, oh, that's interesting, or a friendly LP has helped, or like I've helped other emerging managers who've shared things that they thought were just like, oh, everybody does that, and I'm like, actually nobody does that, and you should talk about that more. So I think it's having that open mind of, just because you do it and thought of it doesn't mean it's actually table stakes. And quick story time. We might cut this, but whatever. This made me think of Alexa talking about like, you're like, I'm not an astronaut. I don't know if you like, so back in 2012 when I was in business school, we did this awful thing where consulting firms or whoever was recruiting on campus would be like, oh my God, we have to do this. So let's just interview 2 of you coffee chats at a time, right? And
No.
I won't name the organization, but it's a management consulting firm, and it has 3 letters in it. But I'm sitting with one of my classmates, Dan.
I'm cringing.
And so
oh.
I'm sitting with my classmate Dan, and he fought, and he was like leader and fought in Iraq, right? And the guy asked both of us, he's like, hey, can you give us an example of leadership? And so Dan starts and he tells this story about like a plane coming down and saving somebody. And then they come to me and say, Ernest, what is yours? I'm like, I don't know how I follow that up. You want to talk about how a spreadsheet didn't work?
Next question, please.
Oh, I have a really bad joke that I'll tell offline. But yeah, I was just like, I'm not set up to win here.
It's helpful to know your competition. You haven't had to be like literally in the pitch room sitting next to them.
Yeah, maybe that's what we should do. Oh, that sounds awful. But yeah, that's what it made me think of. That made me laugh. Charlotte, I know that you're someone who really is a deep thinker, and as you progressed in your career, you think about like, hey, what is the influence I have in my market? And so I was curious, just like, what's your thought on the allocator ecosystem today and how it could change for the better?
There still tends to be, and this isn't just straight unique to the allocator ecosystem, but I think that this is pretty consistent across just the societal context that we live in today. It feels like we're highly polarized, and then there are pockets of thought echo chambers, right? Where if you have certain affinities, you tend to just repeatedly chat with the same people, repeatedly back the same types of strategies, and you very rarely venture outside of those built-in patterns of behavior. And I think that so much of what we value in terms of the GPs and strategies that we seek to back is intellectual curiosity, right? And the ability to really try and get to objective truth. So I think as LPs, we should have the patience and the authenticity to engage with people who have differing beliefs, and maybe take a look at investment approaches that are contrary to what we typically back, right? Like, for example, I'll say that historically I've tended to back highly concentrated venture strategies, but I love spending time with Steve, Kim, and Verdis, who only does really diversified strategies, right? And in doing so, it's actually pushed kind of my own frameworks of understanding as to maybe it's not so much a dichotomy, but rather, right, what types of outcomes you're trying to optimize for, and in what context and stage of assets you're looking to back, right? I'd say if we were more genuinely curious, actually tried to ask questions that help unearth underlying assumptions, and then share with each other what we've seen in terms of what informs our frameworks and best practices, I think this opens up the dialogue and enhances our ability to learn from one another. And perhaps, yeah, you do change some hearts and minds along the way. If we want to collectively achieve progress in the ecosystem, I don't think you do that by essentially shunning those who have different ideas, right? Perhaps that feels idealistically safe at times, but real progress only comes from bringing people into the fold, right, of a concept or a vision that they can actually understand and align with.
Your point about people not sort of recognizing their competition makes me also want to hear how you're viewing venture compared to all these other assets that you're looking at, so that both the GPs and LPs listening can sort of see what's venture doing, what's your perspective on venture right now, and sort of what is it doing in your portfolio moving forward?
Yes. Now, this is a very timely topic, as we actually just spent some time discussing it at our board meeting. But so, if I were to start with, we did this quantitative analysis, right, where we looked at so top quartile Burgess venture returns, going all the way back to 1990 through now. So, right, many types of different economic environments, all sorts of shocks, tailwinds, capital dynamics, and compared it to rolling 12-year NASDAQ returns, right? Because 12 years is kind of the timeline of a fund life. So, call it, there's like the rolling windows, there's like, over 270 windows or so. So about 60% of the time, you are actually better off holding as opposed to doing top quartile venture.
Turn off the podcast, folks. You know what you should go buy.
But that's surprising, right?
Yeah.
I don't know that perhaps we don't always, consistently kind of refresh our analyses of certain asset classes. And I think it's also because being a generalist, right, you're forced to kind of think outside the box as to, rather than having a siloed approach. And so, right, this was something that we did just to kind of understand opportunity cost, if you will. So then what it did point to was, at least at this point, it feels like what you actually need to be aiming for to generate enough of an illiquidity premium in venture is you probably have to be going after top-decile strategies, right? But I have some good news for you, which is if you then study the constituents, right, of who have been amongst the top-decile performers, it's a lot of small, early-stage strategies and emerging managers. So that inherent kind of initial alignment, fund size structure, and real urgency to prove out your thesis and reason to exist, right, does generate some real outsized returns that certainly are worth backing. But those are just some thoughts that I would offer up in terms of venture as an asset class overall.
Good to know for us. Or we were gonna have to this was gonna be our last episode.
Last episode. Oh
no,
wait,
okay.
no, I have another sort of point though also on sort of portfolio construction, which is we always talk about how venture returns are driven by power law outcomes in terms of the underlying portfolio companies, right? But then your venture program returns are actually also driven by power law outcomes of vintages.
Yes.
And so, right, the practicality of having a successful venture allocation, you cannot pick and choose which years, right, you lean into, especially if you're trying to preserve allocation and consistency of relationships with the most elite VCs. You have to be willing to allocate on a pretty consistent pacing basis. And so that is something else that I will point out, which is that, perhaps this analysis, right, doesn't take into the context of it is to be expected that in many years you will not outperform the passive index. But the years in which you do, that's where the 80-20 comes in.
For my last question, typically I like to end on something that's like a nice little bow, but since I have someone who's a friend and a deep thinker, I actually end on something that's kind of big and that people can, at least people wanting more probably. So I wanted to know, we've talked a lot about your perspective and professional background, but what in your personal background has shaped your investment lens?
I think I have to point to my pretty modest beginnings. So my parents actually came here to escape communism in China. They had about $40 in their pocket, 2 suitcases in hand, and then this nebulous idea of what the American dream could be for their family and their kids. So in those early days in this country, we actually completely relied on welfare to survive. And because of these humble origins, I think I empathize with underdogs. Right? I have this poignant appreciation for just how far hustle and grit can get you. And perhaps just more willingness to stick my own neck out to expand access to opportunities for some underserved demographics. I think it's this ethos, which is why I'm so passionate about generating returns for charitable organizations like Inatai, but also the reason why I have the conviction to evaluate and back emerging managers. So within our portfolio, we actually began investing in Fund 1 or Fund 2 with 14 of our GPs.
Wow. That was a great way to end. And now people know that connection when they're banging down your door trying to talk to you. So Charlotte, I just want to thank you for taking out time, sharing your story and perspective. And thanks for being on the podcast.
See you later, Allocator.
After Portfolio Tile, investing with a smile.